Choosing the right lender can make a big difference when buying a home, whether you're a first-time home buyer, moving up, or just refinancing. In Alberta, your main mortgage options are either big banks, credit unions, or what's called B lenders. Each of these options brings its own mix of rates, rules and regulations, and flexibility. Over the next few minutes, I'll take you through what each of these options look like, benefits and drawbacks to each, and how to determine which of these options is right for you. By the end of this video, you'll feel confident about where to go to get your mortgage done right. So let's get into it. So when most people think about a mortgage, they tend to think about the big banks first. These are federally regulated massive institutions that account for about 79% of all mortgages in Canada. The biggest advantages with these are lower interest rates, longer amortization periods, and having access to all of your financial services in one place. The major trade-off here is that the big banks enforce very strict lending criteria. You'll need a solid credit score, a stable income, and your debt service ratios will need to be in line. These banks also fully enforce the federal mortgage stress test, so higher interest rates can reduce your borrowing power. That said, they are convenient, they offer great digital tools, and are a good first stop, especially if you already have an account there. In Calgary's competitive market, going with a big bank can help make your offer look low risk, but the downside is that you're playing by their strictly enforced rules. Next up is credit unions. These are member-owned, not-for-profit organizations that focus on community and customer service. Now, although they are provincially regulated, they still fall under the category of A lenders, and they still offer insured mortgages. Their strengths: they generally have lower fees than the big banks, competitive interest rates on savings and loans, and a more local personal feel. Credit unions in Alberta tend to cater well to first-time homebuyers and people in any kind of unique financial situation. In some cases, they can offer a little more flexibility than the big banks, like waiving the stress test or adjusting proof of income requirements. On the flip side, credit unions tend to have fewer physical locations than the big banks and can offer less robust digital platforms. In Calgary, switching to a credit union can save you some money and offer a more tailored experience, but you'll want to make sure that you're comfortable with branch access and the tech tools that they provide. Finally, let's talk about B lenders, the so-called alternative lenders. So these tend to include smaller banks, mortgage investment corporations, and even some credit unions. These alternative lenders only make up about 20% of the insured mortgage market, and their appeal lies in their flexibility. They're willing to work with people that may not meet the strict A-lender standards. So this would include people with less than perfect credit scores, self-employed income, or unconventional financing sources. So a lot of B lenders will typically require a minimum down payment of 20% and may charge interest rates around 1 to 2% higher than the big banks. Terms are often shorter, around 1 to 3 years, which can actually be a benefit if you do plan on refinancing in better conditions. And depending on the lender, you may end up paying additional fees. So a B lender can be a strong backup if an A lender says no, but you'll need a solid plan to move back to an A lender or be able to manage the higher costs as you go along. So choosing between these lenders will come down to your particular financial situation. If you have strong credit, a steady income, and want the lowest rate, start with a big bank. If you value a community feel, local advice, and potentially lower rates, a credit union could be a great fit. Now, if your income is unconventional, you're self-employed, or have a less than perfect credit score, a B lender might be the key to getting you in the door. Just go in knowing that this is probably a temporary situation and that you'll likely want to move to an A lender at some point later on. A good mortgage broker can show you options across all three categories and explain the nuances of each to you. They'll weigh the differences in flexibility, fees, rates, and lender policy to make sure that you get the best fit. So, which should you choose? Well, that all depends on your particular financial situation and what you value most in the transaction: rate, flexibility, or speed. The good news is that you do have many options, and knowing them in advance can help you have confidence throughout the transaction. If you have any questions or your own personal experiences with any of these types of lenders, please drop them in the comments below. And if you found this information valuable, please don't forget to hit like and subscribe. Thanks for watching, and I'll see you in the next one.